This time, vehicle owners making headlines. TransUnion reporting the percentage of auto loans that are at least 60 days delinquent hit 1.65% in the third quarter. That's the highest rate that we've seen in over a decade. So yes, it's creeping update, but when you compare it to what we have seen in the past, still those delinquency rates are relatively low when you compare to what we've seen in past economic downturns and also during periods of a recession. I think the big question going forward is whether or not we see a significant slowdown in the jobs market, then of course what that could mean for the sector going forward.
I'm a lot more nervous about that number than you are.
Okay.
In particular, anecdotally, I have a family in the car business. We own several car dealerships around the country, and they told me often they're not understanding how many people are coming in and buying cars they ordinarily shouldn't be buying, probably under most circumstances cannot afford. And the highest portion of those delinquencies is those people taking advantage of COVID loan accommodation programs. Look at what happened in big tech, right? They overhired during COVID, not seeing what was coming after COVID. I think you're going to see this number get a lot worse, Rachelle, because people bought cars maybe because of COVID cash stimulus that they were getting. They were sitting home. They weren't going out a lot. They had extra money. I fear this number could get a lot worse in the next 6 months.
And obviously, between the interest rates going up and inflation, we're also seeing people putting a lot more of their debt on credit cards, even for just everyday things, showing that people's finances, those balance sheets might not be as strong as we think they are. And the fact that it's showing up in these delinquencies, I think that's very troubling.
You're not with us, though.
No, I think it's troubling. But what I was saying, I do agree that it's going to get worse because up until now, when you take a look at how resilient the job market has been, some people that were a little bit over leveraged when it comes to some of their purchases, they have been able to make those monthly payments. But here we have Fed Chair Jay Powell saying time and time again that the labor market needs to weaken. So more people are going to be out of a job, which means their budgets are a little bit tighter. So I do agree that it's going to get worse. I was just saying, when you compare what we're seeing today,
1.65%.
Exactly, it's small. It's going to go.
The other
so we're all on the same page.
The other segment I'm watching, though, the other domino could be real estate people that bought in 20 or 21 at that market peak, and they could suffer in the following year or two as numbers begin to fall.
And obviously keeping an eye on the number of people with full-time jobs adding on part-time jobs as well. Something clearly not adding up there.